Welcome to the Deep Dive. We're taking Robert Half's latest earnings call, Q2 2025, and we're going to break it all down for you. We'll cut through the noise, give you the key results, what management's thinking, and what they see coming next. Basically, your shortcut to getting up to speed.
That's the plan. Robert Half, big player in staffing and consulting, they just opened up their books for Q2. Our job is to really pull out the critical stuff so you understand how they're doing in this, well, let's call it an interesting economic climate and what their outlook tells us.
Okay, let's start with the top line view. Q2 2025 performance. Global enterprise revenues hit $1.37 billion. Now, that's actually down 7% from the same time last year, both reported and adjusted numbers.
Yeah. And net income per share. That came in at $1.41, which is, a pretty significant drop from the $1.66 they posted in the prior year.
But interestingly, both those numbers, the revenue and the earnings, they were pretty much right at the midpoint of the guidance they'd already given. So no big surprises there, but maybe the guidance itself reflected, well, a tougher environment.
Exactly. And hitting those numbers, even though they're down year over year, it really just points to that ongoing economic uncertainty we saw all quarter. It definitely made clients cautious, job seekers too. Decision cycles got longer, hiring slowed down, new projects got delayed. The market was kind of tapping the brakes.
Right. So let's peel back the layers a bit more. Segment by segment financials, starting with Talent Solutions, that's their staffing, temp, and perm placements. Adjusted revenues globally for Q2, down 11% year over year.
And if you break that down.
Yeah, U.S. Talent Solutions revenues were $668 million, also down that same 11%. Non-U.S. revenues were $207 million, down a bit more, 13% year over year.
Okay. There was also a slight difference in billing days.
Tiny difference. Yeah. 63.2, this is Q2 versus 63.5 last year. Barely moves the needle. Oh, and currency exchange actually helped a little, added about $8 million to total reported revenue.
Kind of a split, wasn't it?
Yeah, $4 million each for Talent Solutions and their Pro-Div segment.
Okay, speaking of Pro-Div, that's the professional services, the consulting side. Global revenues, there were $495 million for the quarter. And here's where the story changes a bit. Adjusted global Pro-Div revenues were actually up 2% compared to last year.
Oh, interesting. So growth there.
Growth overall, yes, but it wasn't across the board. U.S. Pro-Div revenues were actually down 1%. The real strength was non-U.S. Pro-Div, up an impressive 11%. So yeah, different dynamics depending on where you look and what service they're offering. That non-U.S. growth is definitely a bright spot.
Definitely stands out. Okay, let's talk profitability then. Gross margins, expenses, what did those look like?
Right. So for Contract Talent Solutions, the gross margin was 39.1%. That's just a hair down from 39.3% a year ago. Overall gross margin for all of Talent Solutions also dipped slightly, 47.1% from 47.4%.
Pretty stable then, relatively speaking.
Relatively, yeah. But Pro-Div's gross margin saw a bigger move. It came in at 19.7%, down from 22.5% last year. Even the adjusted gross margin was down 22.3% versus 23.2%. Suggests maybe a shift in the project mix or, maybe more pricing pressure in consulting.
And what about operating costs, SG&A?
Selling, general, and administrative costs, yeah. As a percentage of global revenues, those climbed to 37.1% from 34% last year. Adjusted SG&A also ticked up a bit. For Talent Solutions specifically, SG&A jumped quite a bit as a percentage of their revenues, 49.2% from 43.1%.
So costs rising relative to falling revenue.
Exactly. Pressure on operating leverage there. Interestingly, Pro-Div's SG&A costs were basically flat year over year as a percentage of revenue, around 15.7%. So good cost control in that segment. Okay,
so where does that leave the bottom line operating income?
Well, the reported operating income was tiny, just $2 million, but the adjusted operating income was $59 million. That's about 4.3% of revenue. Now, there was this slightly confusing item, a $58 million gain from investments in employee deferred comp trusts.
Right, I saw that.
But it was completely canceled out by higher deferred comp costs. So end result, zero impact on net income. Just an accounting thing, really. And finally, the tax rate jumped to 33% from 29% last year, mostly because with lower pre-tax income, things like non-deductible expenses just have a bigger relative impact.
Got it. So profits under pressure, margins squeezed a bit. What about cash flow? How's the actual financial health looking?
Good question. Cash flow from operations was actually pretty healthy, $119 million in the quarter.
Okay, that's solid. And what are they doing with that cash?
Well, they kept paying the dividend, $1.59 per share, totaling $59 million distributed to shareholders. And, it's worth noting that dividend has grown consistently. They said it's averaged 11.5% growth annually since 2004. This latest one was up 11.3% from last year.
Wow, that's a strong signal of confidence, isn't it? Even in a tough environment.
It really is. They also bought back some stock, about 450,000 shares for $20 million. Still have authorization for more, about 6.2 million shares left on the plan. Their return on invested capital was 12% for the quarter, which is, pretty decent. And accounts receivable looked fine, DSO at 54.4 days. They're collecting their money.
Okay, so financially stable, generating cash, returning it to shareholders. What did management say about the bigger picture, the economy?
Yeah, they gave some context there. Said that while, global economic uncertainty is still definitely a thing, the really sharp fears of a major recession seem to have eased up a bit.
So less panic, maybe?
Something like that. Also, worst case fears about trade policy haven't happened. Tax changes are now known quantities. That clarity helps businesses plan. And crucially, they noted small business confidence has started to bounce back a little from its lows. That's always a positive indicator for hiring down the line.
And the job market itself, what's the read there?
Fascinating picture, actually. Overall, U.S. unemployment is still low, 4.1%. But get this, for college-educated professionals, it's only 2.5%. And even lower for specialists in accounting, finance, tech. So despite hiring being kind of subdued right now, it signals a lot of pent-up demand.
Like companies want to hire, but are just hesitant to pull the trigger.
Exactly. Management thinks as business confidence really solidifies, we'll see hiring urgency pick up, project demand return, stuff that was put on hold gets going again. And historically, when that happens, clients find their existing teams are stretched thin, which usually drives significant business for Robert Half in those early recovery phases. They seem pretty well positioned for an eventual upswing.
Okay, let's dive into the specific segments again. Talent Solutions, how did the trends look within the quarter?
Right, so revenues kind of drifted down in April and May, but then seemed to find a floor in June. And that stability apparently carried over into early July.
So maybe stabilizing after the decline.
It's like it. Contract Talent Solutions finished Q2 with June revenues down 11% year over year, same as the full quarter. Early July was down 10%, so maybe a slight improvement there. Permanent placement, though, which they always say is more volatile.
Yeah.
That saw a sharper drop in June, down 20% year over year. That was worse than the full quarter's 13% decline. And July stayed weak, down 14%. So perm is definitely still feeling the chill more.
Okay, but I think you mentioned something positive about bill rates in the contract business.
Ah, yes. Good point. Contract Talent Solutions bill rates, adjusted for mix and currency and all that, were up 3.8% year over year.
That's key, right? Shows some pricing power.
Definitely. And they hinted the unadjusted rates would be even higher, maybe 1 or 2 points higher, because they're shifting towards placing higher skilled, higher paid roles over time. Practice-wise, tech solutions are still their strongest area. Things like tech upgrades, ERP implementation, security, privacy, a lot of it, they said, ties into companies getting ready for AI.
Interesting link there.
Yeah, and they think that strength in tech will eventually pull through demand for higher level finance and accounting roles too. Oh, and enterprise clients. Holding up a bit better than SMBs recently.
Oh, okay. And what about Pro-Div? The consulting arm. You said it grew year over year for the fourth quarter straight?
That's right, fourth consecutive quarter of year-on-year growth. But the rate of growth has slowed down. Why? Still that economic uncertainty, it's taking longer to close deals, and the average project size has shrunk a bit.
Makes sense.
They also mentioned a couple of really big projects finished in Q2, and replacing those takes time, so that's impacting the Q3 outlook a bit. However, they said the pipeline looks strong, and new opportunities picked up significantly in the last month or so. They think there's a decent shot at getting back to growth by Q4.
And the non-U.S. strength continued.
Yeah, particularly Germany and Canada, apparently driven by some big joint projects with Talent Solutions. But financial services clients, a big chunk for Pro-Div, are still being very cost-conscious, taking longer to make decisions.
Okay, this brings us to the elephant in the room, AI. What was management's take on its impact?
They were pretty definitive, actually. Said AI has had very little impact on their revenue so far. They looked specifically at roles often cited as vulnerable data entry, bookkeeping, customer service, and said those roles haven't performed any differently from others in their portfolio.
Really? That goes against a lot of the headlines.
It does. They backed it up by referencing an NFIB survey where 98% of small businesses reported no AI impact on staffing, and a National Bureau of Economic Research study finding no link between AI and job growth outside tech firms themselves.
So is Robert Half just insulated somehow, or is the impact maybe further down the road?
Well, their view is the staffing industry is adaptable. They pivot. They've seen transitions with every big tech wave. Plus, remember, 70% of their clients are SMBs, small and medium businesses. They tend to adopt things like AI later budget issues, maybe less need for massive automation, wanting to see proven ROI first. So for their client base, the impact seems minimal for now.
So how do they see themselves competing as AI does become more prevalent?
They feel they're really well positioned to take market share, especially from smaller local staffing firms. Their edge, technology. They highlighted their AI-powered matching tools, lead scoring engines, and massive proprietary database. They think this lets them find better candidates for clients and better jobs for candidates much faster and more accurately than smaller players can.
And they mention having spare capacity.
Yeah, they believe they've kept more recruiters and sales staff on board than current revenues strictly justify. They called it a nice buffer. Means they can handle an upswing without massive hiring. Plus, they expect productivity gains from their tech investments. And their model of using full-time engagement professionals helps them scale quickly and is good for margins.
Okay, looking ahead then, let's talk Q3 2025 guidance. What are they expecting?
All right, revenue guidance is $1.31 billion to $1.41 billion. The midpoint, $1.36 billion, that's down 8% year over year on an adjusted basis. But importantly, it's only down about 3% sequentially from Q2. So the rate of decline is slowing.
And earnings per share?
Guided between $0.37 and 47 cents. And here's another interesting point. The midpoint for adjusted operating income dollars is actually expected to increase sequentially from Q2. That would be the first sequential Q3 increase since way back in 2021. So that's a potentially positive signal embedded in the guidance.
Okay, what are the underlying assumptions driving that? Revenue breakdown?
Yeah, adjusted revenue growth year-over-year assumptions. Talent Solutions down 9% to 13%. Pro-Div somewhere between flat and down 4%, leading to an overall company decline of 6% to 10%.
And margins?
Adjusted gross margin. Contract Talent 38-40%, Pro-Div 22-24%, overall 37-40%. Adjusted SG&A as a percentage of revenue. Talent Solutions 43-45%, Pro-Div 15-17%, overall 33-35%, which leads to adjusted operating income as a percentage of revenue. Talent Solutions 2-4%, Pro-Div 6-8%, and overall 3-6%.
Got it. Tax rate, shares, CapEx.
Tax rate 31-35%, shares 101 million, and full year capital expenditures plus capitalized cloud costs projected at $75-90 million, with $15-25 million of that landing in Q3.
Okay, seems like a cautious outlook overall, but with that hint of sequential improvement in operating income.
Right. And it's worth noting, management kind of hinted they added a little conservatism to that guidance. They specifically mentioned the tone of client conversations has actually been improving lately, especially for Talent Solutions. And those new Pro-Div opportunities are really surging. So maybe, just maybe, there's room for them to beat that guidance if things continue to stabilize or improve.
Interesting nuance. Okay, before we get to our final thoughts, let's do our This Is Not Financial Advice segment. Quick reminder, as always, these are just ideas purely speculative for informational purposes. Always do your own research.
Absolutely. So with that massive disclaimer, here's an outrageous but plausible trade idea, drawing straight from the call's themes. Consider a pair trade. Go long Robert Half, ticker RHI, and at the same time, go short a basket of smaller, maybe publicly traded regional staffing firms.
Okay, long the big guys, short the little guys. What's the thinking?
The rationale comes directly from management's emphasis on taking market share. They hammered that point. They believe their tech investments, the AI matching, the data give them a significant edge that smaller firms just can't match. As the market eventually recovers, even slowly, and that pent-up demand starts converting to actual hires, Robert Half, with its tech, its brand, and that nice buffer of internal capacity, is set up to grab a bigger slice of the pie. Meanwhile, those smaller, less capitalized regional firms might have struggled more during this downturn, lack the tech investment, and might not be able to scale as quickly. So you're betting on Robert Half outperforming its smaller competitors during the recovery, essentially a bet on market consolidation. It's less about the overall economy booming and more about a shift as who wins the business.
That's definitely playing on their competitive positioning narrative. An interesting angle. Okay, so let's wrap this up. Key takeaways from Robert Half's Q2 2025 call. Results were kind of mixed, reflecting that cautious environment. Down year over year, but met guidance.
Right. But importantly, signs of sequential stabilization, maybe even improvement, particularly as Q2 ended and July began, and that potential for sequential operating income growth in Q3.
And strategically, they feel well-positioned with their tech, their scale, and that potential to gain market share, especially as things like AI adoption slowly ramp up across their client base.
Exactly. It really highlights how you need to look beyond just the headline numbers. And again, crucial disclaimer. Everything we discussed is just for information. It's not financial advice. Definitely gives you something to think about regarding the staffing industry and maybe how technology is reshaping competition, right? Is Robert Half's story unique or a sign of things to come elsewhere?
Good food for thought. Well, thank you for tuning into this deep dive on Robert Half. We hope it gave you a clearer picture. We'd love to hear your take. What did you think of their quarter, the trends you're seeing? Let us know. Until next time.